Good morning, everybody. How are you guys doing today? Hope you guys are having a wonderful, great, and unbelievable day. I'm here with Debbi DiMaggio, and with Mr. FM, who is our mortgage broker. So we're gonna ask him a few questions and just gonna keep up how is life in times of COVID-19. So coming in.
Hey there, Javier. Thanks for having me. Great to be here.
Awesome. Hi, Debbie.
Hey, how are you?
Doing
Good to
just
see you guys.
unbelievable.
So one of the questions I had, FM, for you, I know when we were talking, actually it was probably a month ago. I can't believe how fast time has
Yeah,
gone.
it feels like 5 years.
Crazy, all the days. I have to write down what day it is. It's Tuesday today, I think. I hope.
Yes.
Anyway, we talked about a month ago, and rates were not quite coming down. They weren't that low yet, but I think since we spoke, I think the Fed was down, but interest rates for the buyer went down. But have things changed since then?
Well, what's happened in the mortgage market is a little complicated. So you have to kind of understand the various aspects of the mortgage market without getting too deep or too loany. Basically, the mortgage origination business, and I just did this for the California Association of Realtors. They had a seminar for the state last week, and I think it's on their website. But so if you want to see this with charts and graphs, you can go check that out. But basically, the mortgage business itself is split up into the sales aspect, me talking with a customer, quoting a rate, locking a rate, working with someone. And then there's a whole secondary area where the machine of how that mortgage gets created, how that rate gets locked, what has to happen in the bond markets. It's very complicated financial instruments that are used there. And then after the loan closes, it gets pooled and sold to investors. And then you have servicing. So servicing is the area of mortgage where people collect the monthly payment. They report to credit. They pay the taxes if there's an impound account. They do foreclosure. So these are the big kind of chunks of mortgage. And what we saw happen once the COVID incidents occurred, and really the week of March 9th was the bad scene. Heading into that week, Friday, March 6th, rates were great. Stocks were going down. Everybody was getting a little worried, but stocks really tanked that week of March 9th. Bond markets went into a frenzy. Usually when stocks go down, rates go down. That caused a lot of pain. So just before that, the last week of February and the first week of March, we had a record amount of origination. The whole world was refinancing. So a massive amount of loan was moving through the system. A massive amount of need for money to fund it was already there. And then you had wild swings in the bond markets that led to all kinds of activity in that back room I was talking about, where money was bleeding out. Tens of millions of dollars had to leave to cover short positions in the bond market. And then all of a sudden, this big concern came, this cloud that was kind of set on mortgages. The following week, people started to talk about 20, 30% unemployment rates. And all of a sudden, investors, where the money comes from to fund loans, didn't want to put their money into mortgages, not knowing, am I loaning money to somebody who's not going to have a job in 2 weeks, 3 weeks, 2 months from now, right? Mm-hmm. So they started to pull back, and that's where the Fed really stepped in. So their rate drop to zero is for banks. Doesn't have anything to do with mortgages. It means banks that are concerned with liquidity can go to the Fed window and get money for free so they can bolster their balance sheets. But they also announced that they're going to step in as a buyer in the mortgage-backed securities market and all of a sudden provide liquidity there where a lot of investors were pulling out. So we've seen rates stabilize, but that's really only in the conventional space. In the jumbo space, where you still have institutional investors, it's been incredibly challenging. I don't think it's a forever thing. This is better than 2008 because in 2008, we literally saw companies disappear. Countrywide, Washington Mutual. One day they were there, the next day they weren't. This isn't that. This is people pulling their money off the table while they figure out what's going on right now with the employment picture. I think once we kind of get an idea of who the survivors are of whatever we're going through is, right? And whoever then has their job, they're going to keep it. They've made it. They're not affected. Their industry's safe. And then I think you'll start to see money start to flow back into mortgage because you'll know that, okay, the person I'm loaning money to has survived the big blow up of economic catastrophe. They've made it through all of the job losses. Now we're back to good underwriting and all that. So it could be a month or two. But for now, I'm really advising a lot of my jumbo buyers to really just walk into a bank, credit union. That's where the money is. They're getting that money from the Fed window. Conforming loans up to $765,000 were great. Rates are low. The Fed's a buyer. They're keeping rates low. Jumbo money is a little more kind of day to day and a little bit more dicey. So that's my long-winded answer to how's it
That's
going.
awesome. So right now you're recommending, just to recap, because I live and breathe this with you guys,
Yeah.
not out there gets all that. It's very
Yeah.
complicated. But so right now you're not a bank, you are a mortgage.
We're a direct lending mortgage bank, but we're not a depository institution. So
Okay.
we're not a checking and savings kind of Chase, Wells, B of A.
So right now during this, you can do conforming loans, no problem.
Yeah.
And then for people with non-conforming, to go to a bank, a B of A, a Wells Fargo.
I think that's the move right now, honestly. I'd love to work with everybody, but even people who I had pre-approved, I'm having them, because we're starting to see some elements of 2008 where all of a sudden one day guidelines change. Like, for example, Chase, working through us, and they did this nationally, they had a 10% down product up to $1.5 million, $2 million in some markets. They pulled that back to 80%. They stopped doing cash out refi. They stopped doing investment property jumbo. So now you're left with rate and term refinance up to 80 and 20% down purchases. And so and that all of a sudden changes from day to day. So I think it's advisable that if someone's working with a mortgage banker like myself, and they're jumbo, that they should probably walk into a bank somewhere and get a backup pre-approval just to be safe.
And also, and I don't know if this is also on the depository banks as well, but this credit scores for the buyer have to be higher, I believe, and you have to put 20% or more down.
Yeah, flight to quality is what it's all about. So we used to see some little bumps in rate. The rate would get a little bit better as you got closer and closer to an 800 credit score. It's significantly better now. If you put down a larger down payment, if you have a great credit score, you're going to get way better terms than somebody with a 700 credit score and just 20% down. They really, really want quality loans right now. And
they are still running on those then. You're getting rewarded for the high credit score.
Definitely, more so than ever.
Perfect. My client, who you were going to work with, but obviously it didn't work out based on what you just explained.
Yeah.
We're working with B of A right now, and she got a 3% mortgage.
That's great. See, so that's B of A going to the Fed window, borrowing money at 0 and wanting to get jumbo buyers in, because a bank has a lot more incentive to do a jumbo loan because they want a high net worth person. They want that person to use their credit cards, their checking and savings, their wealth management, get an auto loan through them, all that kind of stuff. So they're going to be way more incentivized to cater to that client, especially in this market right now.
Did deal with her at her house in the Hamptons, so they're doing deals with her, and she's able. And what's great about this profile of any buyer like her, she's not tied to a job, because that's not where her money was coming from, and her money was not in the stock market.
Right, huge factor.
On an aside, I mean, if there are buyers right now who have their money liquid and who either have a job or job stability or whatever, those people should be buying now, because there's going to be so many fewer people able to mentally want to make offers, or just the capability to make offers. So
we lost about 10% of the buying population due to product. So we lost all of our non-QM. QM stands for qualified mortgage. It's anything outside of traditional underwriting. So in the last 3 years, we've seen a lot of new product come where you can qualify on your business bank statements, or not even report, not even put anything in for income, or 1 year self-employed instead of the traditional 2 years. All those products went away. So they didn't disappear. Nobody went out of business. That money just got pulled off the table. But that between that and losing that high loan to value, that low down payment option in jumbo, lost about 10 to 15% of the buying population. So that's going to be reduced. Now, I happen to work in a metropolitan area up here in the East Bay that you had multiple offers going into this thing. So it's not like all of a sudden there's going to be a vacuum of buyers, but I'd say the population's down a little bit. So you're right. If someone's looking to buy, it's a great time to get out there with a less crowded field and try to find the house that's right for you.
Awesome. I have a quick question for you.
Yeah.
Last week, I had an escrow falling apart because, the buyer was let go. They don't have a job. Now I'm about to go back to the market, and my seller wants to make sure that I am doing an extra job to double qualify the next buyer.
Yeah.
What would you suggest for me as a real estate agent to pay attention next time I take an offer in one of my listings?
That's a great question because there's so much in flux right now. So you really want to talk to the loan officer and you want to see what kind of loan they're getting, right? So if it's a conforming loan, chances are that's probably not going to be a big issue. But you really, there's a couple of things that are changed just in the last couple of weeks as a result of COVID. So one of them is that anybody who's using assets for down payment that's coming from the stock market, we really have to verify that the value is still there. And the stock market's rallied a little bit in the last week, but we're still down from the highs. So if that was their intent, that's one thing you want to check. Have you verified the assets? Are they in cash or are they in securities? The other thing is employment. So when was the last time the lender double checked with the verification of employment to make sure that person still had a job? You might even want to ask where they work, and try to see, does that signal any red flags in your market? Is this a business that you've heard is in trouble? Is it a restaurant, for example, or is it, some kind of hospitality? Are they a general manager of a hotel or something like that could be a problem? I've got clients who work in the airline industry and haven't flown for a couple of weeks. Their pay stubs are going to show zero. So there's definitely some things you need to go one layer deeper into assets and employment and find out a little bit more about your buyer just to make sure that they're not in one of these red flag areas.
Awesome.
Yeah, I think just being really open and informative and with your seller, and telling them all the things that you're going to do. And obviously on the other side, the buyer's agent and the buyer shouldn't have any concern. You're just doing your due diligence, and you have to do that right now. So I don't think anyone will slight you for that. Adam had a question. He was asking about VA loans and FHA loans.
Yeah. So that's an area. So that's the third leg that we were talking about at the beginning, servicing. So servicing is an entire industry onto itself because the investor, whoever provided the money for the loan, they're not the ones who are actually going to contact the borrower and collect the monthly payment. The servicer is the industry that sits between them. They make a little bit off of each payment, but it's a very low margin industry. Part of agreeing to be a servicer is that you will advance interest to the investor, whether or not the borrower makes their monthly payment. So with foreclosure rates at 0.5%, which is what it's been, we had generational lows in foreclosure rates in January. Servicing was a decent industry to be in. You can make a lot of money servicing thousands of loans. Now, all of a sudden, not only do you have a massive amount of runoff in the last week of February and the first week of March, that's bad for a servicer. When everybody refinances and pays off that old loan, their servicing portfolio starts to shrink because they don't always go back to the same place. So that was already starting to shrink. And then all of a sudden, 2 weeks later, there was a law passed that said, you don't have to make your mortgage payment if you've been affected. And the servicers kind of threw their hands up and said, wait, what are you talking about? This is a disaster for us. What about us? And there's nothing in the bill that protects the servicer from having to continue to make that advance payment. So that area is in trouble. Government loans in particular have a very, very harsh way of treating the servicer. When times are good, it's great to have FHA or VA servicing. The margins are bigger. It's a very lucrative part of your portfolio. If someone doesn't make their payment, though, you're advancing a lot of money to the investor, to FHA, and it's part of the agreement of being a servicer. So right now, again, and traditionally, VA loans, 100% financing. There's concerns about property values maybe having peaked. So someone's going to buy a house at 100%. Are they going to be underwater, several months from now? And FHA, low down payment, generally speaking, it's a more challenged borrower from a credit standpoint. And there's a flight to quality right now. So government loans are available, but the rates are all over the place. I mean, from day to day, I've seen the biggest swings in that government market. So they're still there, but that's one where if you're getting an FHA or a VA offer, or if you're working with an FHA or a VA buyer, you really want to check back in with the lender to make sure that whatever interest rate they qualified at is still available. They might have to rerun debt to income ratios based on where we are now.
Awesome. Thank you. Just a quick question. I've been listening a lot about underwriters, that we have a shortage for underwriters, and a lot of talk about underwriters. So
yeah,
educate us a little bit about what's going on with that.
Well, that goes back to that last week of February, first week of March. More loans hit the system than ever before. Rates were at record lows, and rates are still low, and a lot of people are still refinancing in that conforming space. And we're still 3%. I locked someone in at 3% yesterday on a purchase with a $650,000 loan amount. So the rates are still very low, and the loan volume is high. Now, you guys are feeling it in the real estate market because everybody's locked in their houses, right? So it's hard to list a house. It's hard to buy a house. I still have buyers going into contract, though. I had 4 last week, and it's Tuesday, and I've already had 2 this week. So there's still some activity out there. What's that?
Are those conforming loans?
Those are conforming loans, yeah. General price points around kind of, some of them are large down payment, around $1 million-ish, maybe 300 down, 250 down.
Okay. I was just like, I rarely do a conforming loan. So
Yeah.
I was like,
well, hey, you live in Piedmont and Beverly Hills. It's the
and the whole VA thing, that wasn't my question. I still,
yeah. I think the last VA loan you did was back, I don't even know when.
I don't know if
mine was
never done one.
Yeah, there you go.
Never done one in 30 years. And then also I will say, usually in a normal market, if I didn't have an appraisal done within like the first 3 days, I'd go crazy.
Yeah.
And now I'm on the 3rd week because there's only so many appraisal companies working right now. Will that change, FM, or are appraisers essential or non-essential, and will that change? Because right now there's very few in the Bay Area that are working. I'm on my, I won't have an appraisal till next Monday, which will be week 3 of a deal I'm working on.
Wow. Yeah. So we're having good luck with our appraisers in the conforming space for 2 reasons. One is that we, as a company, we have our own appraisal management company, and we have a lot of appraiser staff locally. They're independent contractors. Some of them have gone under the financial services umbrella and deemed themselves essential. Some of them have not, for their own safety, and we can't force anybody to do it. Now, again, a conforming advantage, not only are the rates great, but there's some flexibility now with appraisal. So on a purchase, you can do a desktop or a drive-by and not have to go into the property on a conforming loan. So we're getting appraisal turnaround within a week or so, week to 10 days on our conforming loans, because nobody has to go in. They don't have to call for an appointment. They just have to do their due diligence using their computer to look up comps and things of that nature, and then do a drive-by if they want to. But they can even just do a desktop appraisal.
What about
non-conforming? It's lender to lender. So Chase just allowed for drive-by. So they fell in line on their jumbo product with conforming. I'm not sure about B of A, Union Bank, Wells, and the others. That's I haven't seen any guidance out of anybody other than Chase.
Oh, wow. Okay.
Yeah, perfect. So what we're gonna do is we're gonna meet you up on Instagram Live.
All right.
At 9 o'clock.
Can't wait.
Perfect.